Hey guys, it's Luron here and welcome to another video. Now in today's video I'll be covering the market crash of 2020 due to COVID-19. Now lately I've been getting a lot of questions regarding whether now is a good time to start buying stocks now that the market has crashed. And in this video I'll be answering that question and more. Obviously a lot of people are wondering whether this is the bottom or whether we have more to go before we hit the real bottom, and all of those questions will be answered in today's video. So if you're someone that is looking to turn your financial position around, turn your future around, then you definitely don't want to miss this video, because opportunities like this don't come very often. So when the market crashes like this, the last big crash we had was in 2008 in the financial crisis, and that's where millionaires are made. So if you guys are looking to capitalize on this market crash, then this video, it's gold. It's a golden gem, guys. You definitely don't want to miss this video. You want to watch this video all the way to the end so that you don't miss out on any crucial information that you'll need to get your 401k or your RRSP growing as it should. So when you're ready to retire, you can have some sort of money or sort of financial position that will help you to retire in a comfortable position. Now, as you all know, the coronavirus has the world in an uproar right now. So I just want to remind everyone, I know a lot of you are practicing social distancing or physical distancing, whatever you want to call it, whatever name you want to give to it. So I encourage you to continue to do just that, and that will obviously help us to get back to some form of normalcy in short order. So a quick disclaimer here, guys. Take a few seconds to read that to make sure you're comfortable with the material you're digesting. So here's our table of contents. So just to give you guys a quick overview as to what we'll be talking about here today. So today we'll be looking at my top 6 ETFs to invest in this month for the long term. So again, as I mentioned earlier, if you're looking to really optimize your 401k or your RRSP if you're living in Canada, I'll be giving you guys 6 ETFs so you can invest in and will help you in the long term. The second item I'll be touching on is I'll be reviewing the technical charts of these ETFs, so you'll see exactly what are the levels that I'm considering entering on and these type of stuff. I'll look at the review. I'll review the past performances of these ETFs, so we'll go back maybe 20 years so you guys can see whenever the market has crashed, how the market has recovered over the past few years. We'll also look at how to manage your 401k and your RRSP investments. And then finally, I'll close by giving you guys my 10 top stocks to buy right now. So if you stay to the end, that's the bonus. The last item is a bonus item. So if you stay until the end of the video, I'll be giving you my top 10 stocks to invest in. So let's dive right into it, guys. So what's an ETF? An ETF is an exchange traded fund, as the name suggests. Usually it's a type of security that involves a collection of securities, such as a stock. I like to look at ETFs as a basket of stocks, right? So let's say you want to invest in, for example, the aerospace industry. You want to invest in the retail industry. There's usually an ETF that you can actually buy, and you'll get a combination of stocks by just buying one ETF. So versus going and buy 10 to 20 stocks, which will kill you in fees if you have to purchase 10 to 20 stocks, you buy one ETF and it will give you ownership of all of those companies combined. So for example, if you like energy, oil and gas, you can buy one ETF for oil and gas, and it will give you a number of stocks built into that ETF. Same for gold. If you want to buy gold, you can buy an ETF for gold, and it'll give you all the gold related stocks within that ETF. So ETFs are very powerful, and it's a great way to diversify your portfolio, so to speak, without purchasing a whole lot of stocks and paying a whole lot of commissions to own those stocks. There's also mutual funds out there. So if you buy stocks through your bank, most time your bank will try to promote mutual funds for you to invest in. I don't like that route, because I've tried that in the past few years, and what I've learned is that with ETFs there's tons of fees that are associated with ETFs. I think usually 1 to 3% the bank will charge you for owning their ETFs. And ETFs, they're not usually found on the exchange. So let's say you have a TD Ameritrade, TD Thinkorswim account, or you have an Interactive Broker account, whatever platform you trade on, you just can't type in a ticker and find a mutual fund, but you can do so with an ETF. That's why, as the name suggests, exchange traded fund, because it's available on the exchanges, so it's very easy to actually acquire. The fees for ETFs are pretty low. A lot of them are under 1% fees, so that makes them very attractive to own. So here are my top 5 or 6 ETFs for 2020 that I believe everyone should consider due to this market crash to own right now. So the first one I'm looking at here is the Invesco QQQ. So in 2019, you can see here the performance was pretty good. We had a 38.6% performance to the upside for this ETF. So had you invested your money in this ETF, you would have had a 38.6% gain in 2019. Net asset on the ownership is 87 billion. Expense ratio just about 0.2%. So to give you guys some perspective on that, if you invest $10,000, you'll pay $20 in fees annually. So that's peanuts, guys, compared to owning a mutual fund, which will cost you a lot more for ownership. Also, this the QQQ ETF is a tech-heavy fund with big names that you're used to. So all your Amazon, your Facebook, your Microsoft, all of those tech companies you'll find within the QQQ. So that's my number one. No particular order, but that's number one I mentioned here for ETFs. The second ETF is a high dividend yield ETF. So it's a Vanguard high dividend yield. The ticker symbol is VYM for this ETF. So if you're looking to trade this ETF, you want to type in VYM, or you can type in Vanguard high dividend yield within the search in whichever broker you use to trade stocks. So in 2019, this ETF at a 23% upside performance. Net assets under ownership is 38 billion, an expense ratio of 0.06. So just imagine, guys, if you invest $10,000 in this ETF, you'll pay $6 in fees annually. So nothing to talk about here when it comes to fees. The third one we have here is biotech ETF. So this is a SPDR S&P biotech ETF. So the ticker symbol for this one is XBI. So if you're looking for trade this one, it's a biotech ETF, SPDR XBI. So performance last year was 32.6%, which is pretty good. Expense ratio of 0.35. So you'll pay $35 on a $10,000 investment. And I like this one in particular because right now with the Covid-19, the virus, a lot of biotech companies will be doing well. They'll be doing clinical trials, and they'll be looking at vaccines. They'll be looking at so many other, therapies that can help with the virus. And I think biotech sector will actually be a high performer in the next couple of years to come. So this is definitely one of the ETFs, one of my favorites. So something that you should consider as well. The fourth one I have here is the SPDR S&P 500 ETF. So this is a very popular one. This is the SPY. So as some of you may know, SPY basically tracks the S&P 500. So all the stocks that are in the S&P 500 index is in the SPY. So if you want to own the S&P 500, buy the SPY, which is the cost of the SPY. You'll probably pay $200 something for one to own one ETF, or within the SPY. And as I said, it tracks the S&P 500 stocks, all of them. So this is a pretty attractive one as well. Expense ratio is pretty low. You can see here 0.09%. So you'll pay $9 on every $10,000 invested. So pretty good. We have the SPDR Gold Shares ETF. So this one ticker symbol is GLD. So if you're looking to trade this ETF for gold, it's GLD. That's a ticker symbol. Last year it had a 19.36% performance, 0.04% expense ratio. Pretty low expense ratio, guys. You'll pay $4 if you invest $10,000. And this one tracks all gold related stocks in the S&P 500. So if you're looking to own gold, you don't have to buy one company. I like to use the example, this one, guys. Let's say you buy Barrick Gold. That's a large gold company. And let's say for some reason the company had some mismanagement, and then the company performance, tank, for a few years because of poor management. Then you'll suffer huge losses, right, in your portfolio if you just own that particular stock. But when you own an ETF, the ETF is a combination of Barrick Gold and many other top gold-related or mineral-related companies in the industry. So if one company should do a little poorly, then there's other companies that'll be able to keep your portfolio up and not allow it to just fail, unless there's overall market crash like we're experiencing right now. So this is the gold ETF, guys. And then we have the Vanguard Energy Index Fund ETF shares. So this one is ticker symbol VDE. Performance last year wasn't so good. As you guys know, the oil and gas industry, the energy industry, was under some pressure for the past few years, obviously because of the price war between OPEC countries. Like right now there's a big price war going on between Saudi Arabia and Russia, so that's causing some suppression in the price of oil and gas. So I don't think that will last forever. So this ETF is basically on sale right now. That's the way I like to look at it. It's sold off, I think, about 60%. We'll get into the chart just now, guys, but you'll see that this ETF has been sold off for about 80%. 60%, sorry. And as you can see here, the expense ratio is pretty low for this one. It's 0.01%. So you'll pay $10 on a $100,000 or on a $10,000 investment. You'll pay $10 for the year. And this one track all energy related stocks within the S&P 500. So your BPs, your Chevrons, all those top oil and gas company, Exxon Mobil, all of them are tracked under this energy ETF. So those are my 6 ETFs that you should consider, guys. They've all been sold off due to the market crash, and definitely a good time to start considering some positions on those ETFs. Now let's look at the technical charts, guys. So these were from finviz.com. So I just took some snaps of these ETFs so you guys can see how these stocks have failed over the past month or 2 months. So as you can see here, late February is when the market actually crashed, and this triple Q ETF crashed by I think 28% from its highs. So you can see this ETF was all the way up at $235, and it crashed all the way to $170. So that's a like I said, it's a 28% crash or correction, and this market won't continue to crash all the time. I mean, it could go down some more, but no one knows, guys. Like no one knows like where is the exact bottom. But we also know that around 30% is when we're in a bear market. And also it can be considered a recession if you have multiple quarters where the market is sustainably lower. But for me, these are low enough levels for me to take positions, because you can wake up tomorrow and the market can be up at 210, and that's when a lot of people start entering the market, and that's not good. Why would you want to enter when it's at 210 versus when it's at 170? Buy low, sell high. Sell high, buy low. That's investing 101, guys. So now is a good time to start entering. I mean, it's possible that this market can pull back a little bit to test these lows, but for me, I start taking position right here. If the market pulls back some more, I'll be entering more, I'll be buying more. But right now at these levels, it's definitely a good time to start. If you have $10,000 to invest, at least put in a quarter of that investment to get things going. But because you can never really estimate the real bottom. Either you're going too early, you're going too late, but at the end of the day, the market is down, so it's time to enter, guys. That's the bottom line. So this is the triple Q We have the VYM chart we're looking at right now, and this one has pulled back 37%. So this one is a high dividend yield ETF funds, and like I said, 37% pullback here, guys. So definitely want to consider. We're looking at the XBI charts right now, and as I mentioned earlier, this is the biotech ETF, and this one has failed 34% over the past couple of months. So something to consider as well, guys. As we can see here, the SPY, which tracks the S&P 500 index, the SPY is failed by 35%. From its highs. So it was all the way up at 340, got pulled back all the way to 220, and now it's, made a small correction up to the upside, but it's, pulling back as well. So something to consider here, guys, this SPY. All of these ETFs, just a disclaimer, I have ownership of all of these ETFs because, like I said, these market crash don't happen every day. They don't happen every 2 years, every 3 years. They happen every 8 to 10 years. That's when these happen. So just imagine let's say you just finish, you just learn about trading or investing, and you go into your bank, and your bank said, let's say you went to your bank last year, you weren't trading the stock market all the time, and you go into your bank let's say November of 2019, and your bank say, hey, you need to own some mutual funds or some ETFs, and they promoted these ETFs that I'm showing to you right now, and they told you need to buy. Guess what happens, guys? Especially with mutual funds, unless you got 100,000 plus in under management for the banks, they're not actively managing your funds. They just put it in a fund and they leave it there. When the market crashes, you just lose your money. So if the market crashes 30% and you have a mutual fund, you'll just lose 30% of your money. And if you went in back in 2019 when the market was high, you would have just lost 30% of your money. And then the bank doesn't care because they don't actively manage your money. It's passive investment. They create a portfolio, they put your money inside, and then just does what whatever the market is doing. So now the market has crashed. Now it's time to enter, guys. This is a nugget I'm giving you here, guys. Hope you guys are taking notes with this particular one. The market usually corrects itself every 8 to 10 years. The last crash that we had was in 2008 due to the financial crisis, and then now 2020 the market has crashed again. And when the market crashes, that's when you buy stocks, that's when you buy ETFs, and then you hold it for another 3-4 years. I mean, you can hold it for the next 7 to 8 years and then wait for the next crash, but that's pushing it too close, guys, because if you hold it, you get all these gains, maybe a couple 100% on your investment, and then you just hold it into the next crash, then you lose a good bit. So you have to have a target, whether it's 100%, whether it's 50%, whether it's 200%, and you get out of the market, and then you can make some other small short-term plays. But you sell, you buy and you sell. Too many people buy stocks and then just hold them forever because they heard that's what Warren Buffett did, that's what Bill Gates did. They heard all of these stories that, you just buy stocks and you hold them till you retire and then you'll be rich. A lot of people that I know right now personally bought stocks and just sitting on them, but they bought when the market was high, and now the market crashed. They're old, they're in their 50s and 60s, and then they're just sitting on a loss when they're supposed to be retiring with lots of money, right? So you don't want to be like that, guys. That's why I'm doing this video. Buy low, sell high. The market has crashed right now. Now it's time to buy. So I might be going off tangent there and kind of ranting, but I just need to hammer a point home for you guys. So this is the gold ETF. So as you see, the gold ETF has dropped 18% over the past 2 years. But this one in particular, usually when the market is crashing, gold usually goes up in price because when everyone is pulling their money out of stocks, they're putting it into gold. They believe that gold is that reserve metal that they want to own when the market is crashing. So you'll find here that gold didn't really crash that much when the market pulled back. Instead, gold went up. If you notice here, gold is now has retraced and now it's back to 152, close to 160, where it's all-time highs there. So I wouldn't be buying gold ETF right now. As the market started to go back up in the next few months, I'll keep an eye on this ETF, and as the market goes up, usually gold will come back down. So when gold comes down, then I'll be looking to enter anywhere between the 135 and 140 mark. I'll be looking to take a position with gold. And then we got VDE. So this is the energy ETF. This is the one I really like, guys. So look here, this one is down from 80, 85 all the way down to 30. That's a 58% decline, guys, a drop in price. This is on sale. This is on sale. Like I said, in the energy industry has been in a funk for the past few years, but it won't stay there, guys. It'll bounce back. So this is the one you want to really capitalize on. For me, that's the one I'm capitalizing on, because this is on sale. This ETF is on sale. It's time to buy. And then just a quick snapshot here of the performance, guys. So this is the triple Q I'm looking at here in the VYM. They're side by side. Sorry for making it so small. Hopefully you guys can read that. And the source for this is Yahoo Finance. So if you can see here, the ones in red is when the market crashed. So you can see back in the 2000s, the market had crashed. And in the next 5 years, the market really went on a rally. 2008, the market crashed 41% for the triple Q. And then nothing but green here for 8 to 10 years after, guys. And then in 2020, there's supposed to be another red bar here, but the Yahoo Finance didn't show 2020 market crash. But as the market crashed, guys, you can see here the red and the green. Whenever there's a big red, years after, it's followed by massive greens, massive gains. So you don't want to wait till it's green to buy. You want to buy when it's red. So the next few years, you can be just watching your 401k or your RRSP just grow. So look here, guys, red and then just green, red, then just green. That's how you invest in this market, guys. We're looking at the XBI, we're looking at the SPY 2008, red, and following that is just green. All the years ahead is just green, guys. Look here again, gold and VDE, energy, red followed by green, red followed by green. That's how you want to invest. So how to manage your 401k and RRSP investment. I think I've started to touch on all those already, but this is a chart showing you the S&P 500. So back in the 2000s, those same performance chart I just showed you there, this is just a technical chart showing you a different representation of that same information. So S&P 500 was all the way up to 1500 back in the 2000s. Guess what? It crashed to 750. So that's half, guys. It crashed by 50% back in 2000. So when it pulled back here, guys, that's when you buy. And then it goes up for the next 8 years, all the way to 2008. The market just went up to test these previous highs. And then in the financial crisis in 2008, the market crashed. And then it's the bottom here, right? That's when you buy again. The market crashed almost 50%. And then for the next 10 years, the chart just went soaring. And if you go to your banks, anywhere along this line, they'll sell you mutual funds and ETFs. So people who are not smart and savvy investors, they'll just buy all along here for their mutual funds and ETF and RRSP. And then the market crash. Like for me, I know anywhere along this line, it's time for correction. Here, it was due for a correction, for at least a pullback, but it didn't. Just continue running. 2018 was the year it's supposed to crash, just didn't crash. So there we go, guys. So that's it in a nutshell, guys. And as promised, I told you guys, if you stay all the way to the end of the video, I'll give you my top 10 stocks that I'm looking to invest in as well. Here are my top 10 stocks, guys. We have Apple, Disney, Chevron, McDonald's, Lululemon, Enbridge Pipelines, Amazon, Microsoft, Visa, or MasterCard, whichever one you choose. They're both great investments. And Boeing. Now, Boeing is one of my favorites because Boeing has had a major crisis over the past few years, and the stock has really sold off. Almost 70% of value this company lost. And this is a massive company. Almost half of the planes that you fly in whenever you're traveling anywhere, they're Boeing jets. So I don't think this company is going anywhere anytime soon. So this company is on sale right now. Like all of these companies are on sale, but the one mostly on sale is Boeing. So that's the one I'm looking to really load up on right now. So that's it, guys. There you have it. Those are my top 10 stocks to buy. And I've just gone through my 6 ETFs. If you're looking to have more like a portfolio or a basket of stocks that you own in different sectors, in different, whether it's energy, gold, biotech, those are the ETFs you want to consider that I provided overview on. And these are my top 10 stocks to buy now. Obviously, there's other stocks that are on sale right now that you may love, you may have more details on. You can definitely consider those as well. So that's it in a wrap here, guys, and I'll close by showing you guys here. Now, Warren Buffett once said, be fearful when others are greedy, and be greedy when others are fearful. Guess what, guys? The market is crashing right now and everyone is fearful. So now is the time to be greedy. But usually when people are greedy, the chart that I showed you earlier, right? People are usually greedy when the market is going up, 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 up. Everyone is greedy. It's like, oh, we got to buy, their grandmother and everyone is buying stocks when the market is going up. That's not when you really buy stocks. You can trade. You can do some more short, medium-term trading. But when you really want to load up, guys, it's now. Everyone is fearful. Everyone is panicking like, oh, where's the stock market going? Is it going to zero? No, it's not going to zero. So all the savvy investors are buying up stocks right now. I'm a savvy investor. I'm buying up stocks right now. But you're not hearing that on the news, on the market, about the market. You think these big-time investors aren't buying right now? They're buying, but they're not buying it in such large quantity that the market will go up. They're buying, they're accumulating stocks. I don't know if you guys know about the market cycle. That's for another video. But there's accumulation, distribution. These guys are accumulating stocks right now. So they accumulate stocks, but they're not pushing the price up. But they're grabbing stocks. And then they'll gradually move back to the upside. So guys, that's it. I'll end the video here. A lot of ranting here in this one. Hopefully you guys enjoyed the video. Please remember to share, subscribe, hit the subscription button, leave a like, leave a comment if you enjoyed this video. If you have any questions regarding investment, regarding anything that was mentioned in this video, please let me know what you think. And we'll close it here, guys. So be safe out there, guys. Take care.